We are entering uncertain times as an economic recovery seems less and less optimistic with the resurgence of COVID cases around the United States. Joining me today is Ryan Giannotto, Director of Research at GraniteShares. Ryan, welcome back to the show.
Thank you very much, David. Thank you very much for having me. It's great to be back.
Always a pleasure. So in your recent research notes, you have discussed the impacts of a resurgence of COVID on markets and gold. Can you just start by talking about what you mean by resurgence? Have we ever exited the first wave, or is this a second wave?
Well, in terms of COVID, it's a very interesting situation because what matters less is not the facts on the ground, but more so the public perception. And that's what's really hard to game out here as we go into fall, proceed through summer and go into fall. And we discuss school reopenings, colleges, and broader segments of society. This is what's really difficult to try and understand and game out and model because it's not hard, cold data that make the decision. It's public perception and an understanding of what the reality is. So it's a very different situation. Sure.
And how would you characterize public perception? Is it one of fear? Is it one of hopeful optimism? Is it one of cautiousness? Is it one of reckless ignorance? How would you describe it?
Yes, yeah. I mean, those are very different categories. Ultimately, I would say there is a lot of fear in the populace, and this has been echoing, ever since the first days. Really, since we really dove into this in March. There's been a lot of fear, a lot of caution, and this is what's going to be firmly pressing on the decelerator, pressing on the brake as we try and reopen segments of the economy. Already seeing California, Florida, Texas trying to decelerate or even go backwards in their reopenings.
So some analysts I've spoken to have said that it really is impossible for the governments to reinstate a lockdown statewide or even nationwide, because that would really send us back, to the Stone Age. Is that? I mean, what are the chances of that happening, Ryan?
Ultimately, I would say very slim, because at the end of the day, at this point, the economic policy of top-down lockdown is it's not feasible. It's no longer possible unless governments are willing to enforce it. With the police, with the military, it's not going to happen. And that's what's really going to happen. Are you going to see self-quarantine? Are you going to see citizens just, captured in their own fear, unable or unwilling to engage in economic activity? And to your point, if we did see top-down policy of, mass quarantine again, the leading economic activity, in New York City in the financial district would be hunting for deer. It would be, back to the Stone Age, as much as you said.
What are some of the economic leading indicators that you're looking at that would gauge either consumer confidence or a potential recovery back to pre-COVID levels?
It's very difficult to say. Really, I want to see, use of mass transit. I'm going to want to see an uptick in job hirings, especially the weekly numbers. I am very skeptical of the official, jobs numbers put out. I just think the magnitude of what's going on in terms of the velocity of job gains and losses is orders of magnitudes beyond what they are prepared to calculate. It's, we've seen a whole market cycle in a couple of weeks.
In respect of the forces on the market, what would you say is a stronger force, COVID or the Fed?
Quite simply, people are paying attention to all manner of forces. Goldman Sachs is talking about the economic impact of wearing masks. That was a big report that just came out. But really, it's Powell. There is no other factor that is moving the market as much as Powell. Even, I would go as far to say that Powell is 99% of explaining returns in this market. It's just really unfathomable to think of the effect of expanding the balance sheet by $3 trillion. And not only just a raw expansion, but buying assets such as, not only tried and true real estate, which has already been done since QE3, but also including, commercial paper and even corporate debt. I like to say the Fed has now turned into, basically just an army of Robinhood traders. It's a very, it's a very, very humorous image to see, the Federal Reserve Board, sitting around on their smartphones, buying and selling LQD in their little Robinhood accounts. But that's exactly what the Fed has turned into, and it has sent asset prices surging.
Are you suggesting that they don't really have any discernible long-term plan beyond what a typical Robinhood speculator would have?
You know, I don't know. I think that might be insulting to the long-term plans of Robinhood traders. You know, they have very concrete plans. They can tell you exactly what they want to do with their winnings or potential winnings. The Fed, all we've heard out of them is they are not even thinking about contracting monetary supply through 2022. That's the earliest horizon, and if there is any hesitance, we're going to have to see a further expansion of, basically currency debasement to pay for these economic losses.
So, Ryan, when you talk about the Fed specifically, are you referring to Powell's outlook on economic growth, or are you referring to his dovish stance? Those may be correlated, but keep in mind that Powell's stance on the economy is rather gloomy. But at the same time, equities investors are maintaining a bullish stance, as can be evidenced by the fact that we're almost near February highs in the stock markets. Where do you see this conundrum here?
Yes, yeah. I mean, much as you pointed out, I would say that the economic outlook and asset prices right now are negatively correlated. The gloomier the long-term prospects, the higher asset prices will go, because it just means Powell will have to dig in deeper, as well as the federal government on the fiscal side, to sort of bail out the economy and shore up, the shakier investments in the economy. And that's just going to send asset prices skyward. What will be the next asset Powell buys? That's the question that's driving the market higher.
Okay. Could it be gold, Ryan? Could they buy gold?
I like to say gold is the one asset that has not had to have been bailed out in this market fiasco all around. Bonds, it's really, really very quite, I think, ironic to look at the hypocrisy that surrounds the fixed income investments, where they are sold as a non-correlating, a safer investment, when really gold is the only investment that has not had to have been bailed out by the Fed. I guarantee you, Powell is not going and buying, BAR, BAR, the GraniteShares BAR ETF on his Robinhood account like he is with, the blue chip bonds or BlackRock.
Okay. Now let's talk about your assessment on gold prices. Now, in one of your latest pieces, you wrote that there are three major characteristics of gold that make it an attractive investment right now. One is the potential as a safe haven asset. Number two, the significant diversification characteristics of gold. And number three, dollar insecurity in the new Fed problem. Can you break down these three characteristics for us, Ryan?
Yeah, absolutely. So I would say these are three classic arguments for gold. But what has happened is the coronavirus pandemic has really just amplified the significance of each and every one of these, sort of tenets for gold, amplifying the need and importance to the everyday investor as well as to the macroeconomy. So first off, in terms of a store of value and a potential safe haven, gold is one of the few assets that has not had to have been bailed out by Powell, by the Fed. And as a result of this, it has been one of the best performing assets, year to date, as there's just been a flight to quality, a flight to safe haven investments. And gold, it really is the gold standard of defensive assets. And, we've seen that the road to, 1800 and beyond may now be open.
I remember last year you were talking about asset allocation for gold, and it was a theoretical number that's obviously much higher than what a lot of people practically hold. Do you still maintain that view on allocation, or have you changed that number since?
Honestly, I think that number has gone up higher. We're now seeing that if you take a conventional 60-40 portfolio, 60% stocks, 40% bonds, you are much better off replacing that entire gold, that entire fixed income component, and replacing it with gold. The risk return characteristics, even in 2019, were far superior. Even in the best year for bonds, gold with its diversification, potential really outshone bonds, which have now become not only anemic, but also, again, subject to the whims of Powell. You're making an investment that is really backed upon the decision of one person. And that's, I think, a very risky proposition.
Okay. Now, finally, Ryan, GraniteShares has issued a relatively new fund, the XOUT fund. It was incepted last year, was it not?
Yes, it went live last October, and since then, the XOUT index has racked up more than 9% outperformance versus the broad market, the S&P 500. And the way it does this is by seeking to eliminate, the companies that are lagging, that are subject to disruption, that are prone to failure, vulnerable in this market economy. And by doing so, by trying to eliminate losers as opposed to pick winners, it's been able to achieve, really quite remarkable outperformance, about a 1%, 1 percentage point of outperformance, basically on a monthly basis.
Okay, now XOUT was created last year. Have you changed the constituents since the outbreak of COVID?
Yes, unlike the S&P 500, we have rebalanced each and every quarter. We see it as just a core responsibility of a asset manager to basically maintain the methodology they set out with. How else can you be dependent upon? And the top eliminations we've made this past quarter, J.P. Morgan, Visa, and Walmart have delivered surprising amounts of gain relative to the broad market. Other notable exclusions include Exxon, Chevron, and Verizon and AT&T. These are companies that face, that have been pressured by the coronavirus pandemic, that they are subject to disruption, and their long-term growth potential has been severely impaired. And this is the entire philosophy of the XOUT fund, trying to eliminate weakness in the market, trying to eliminate losers instead of picking the winners. The winners will hopefully take care of themselves.
Yeah. Do you see a potential for the coronavirus epidemic and actually the greater recession at large that we're facing right now to drastically shape or reshape the investment landscape? A lot of industries have shown that they are vulnerable and susceptible to a negative demand shock. Have you, as an investor, as a portfolio manager, changed the way you think about where to place your capital?
Absolutely. I mean, that's a really fantastic synopsis of what's going on in the market. Is that, basically the market gains have been captured by a very few number of stocks, while the vast majority are subject to really quite significant long-term impairment. And I think energy sector in particular is really ground zero for this movement. Really, as you said, subject to a just critical demand shock. It's really very difficult to see how the energy sector will ever regain its prominence. Exxon in particular was once the most valuable company in America. It was the single largest company by market cap. And actually, the past 9 months, it's actually been the single largest destructor of shareholder wealth. And by eliminating a name like Exxon and reinvesting it in the other 499 companies, you've outperformed by about 0.5 percentage point right there. And that's the thesis of just leaving out the companies that have been, relegated to secular decline. And the coronavirus pandemic has only amplified this thesis, as many companies that were significantly burdened with debt and long-term obligations have been unable to, basically, even at rock bottom interest rates, they've been unable to service their debt. Chesapeake is another great example, just declared bankruptcy. That used to be an innovator, an industry leader, pioneer, and now it's gone.
All right. Those are fantastic thoughts, Ryan. I appreciate you coming on the show today. Thank you very much.
No problem. Thank you very much, David.
I'm David Lind. Thank you for watching Kitco News. Stay tuned. We'll have much more for you.